Hello, everyone, and welcome to MSUFCU's Financial Education Seminar Series. We appreciate you all joining us and are excited to be here with you virtually this evening. These presentations were created with you in mind, with the intention to give financial education on a number of relatable topics to help expand your knowledge of finances. Each event will be hosted by a member of our financial education department or by one of our partners, connecting you with resources in our community. We have a number of diverse presentations planned for you this year, and you can explore and register for them by visiting us at msufcu.org/events. Tonight's event is being recorded. To rewatch or share any recorded presentations, you can go to youtube.com/msufcu and then select seminar series from the playlist options. I'm Therese Bacon, a financial educator here at MSUFCU, and I'll be presenting on controlling your credit this evening. If you have any questions throughout the presentation, you can feel free to submit those using the Q&A function at the bottom of your Zoom screen, or you can chat me directly. Chat isn't open to the whole forum, but you can chat me directly if you can't find that Q&A function and get those questions to me. And then I'll be happy to address those at the end of the presentation. So let's go ahead and jump right into it this evening. So we are going to be talking about credit basics. So really like, what makes up your credit report and some things like that. Then credit factors. So, the different items that actually go into what makes up your credit score. And then also taking action. So we'll be touching on a couple things, maybe, how to dispute items that aren't legitimate on your credit report, or how to check your credit report on your own. So we'll get into a couple of those as well. So we'll start with some true or false. So maybe these are some myths that you've heard about credit before. So let's see where you're at as far as your knowledge on a couple of these tricky questions. So the first one, true or false? Closing newly opened credit cards has no impact on your credit score. So you can chat in directly if you want to answer this. True or false? Does closing those newly opened credit cards have an impact on your credit score? Yes, so we have a couple people answering, and you are correct. This is false. So closing newly opened credit cards can, in fact, impact your credit score. And here's why. So first is credit utilization ratio. So this is the amount of credit that you're using compared to your total available credit. So if you close a card, especially one with a higher credit limit, your total available credit is going to decrease, your available limits are going to decrease, which is then going to increase your utilization ratio and then ultimately lower your score. Another factor of why this is false is length of credit history. So closing any line of credit is going to take away whatever good positive credit history you've built up at that point. So although closing, accounts that are in good standing, those will still remain, they'll still show on the credit report for up to 10 years, but eventually they are going to fall off. If the closed card, in this one, it was a newly opened card, but if you close a card that, was maybe your oldest credit account that you had, that's going to shorten your average credit history over time as well, which is then going to also negatively impact your score. It also can have to do with credit mix and inquiries. So, if you're just opening a new card, that means that there was a hard inquiry on your credit report when you applied for that card. So that's already, possibly affecting your credit score a little bit. Sometimes we see credit scores, go down by maybe 1 or 2 points with each inquiry. It just kind of depends on each person's, report. But also credit mix. So having different types of credit. So, if you have maybe an auto loan and a mortgage, and then you only have one credit card and you close that credit card, that's going to affect that credit mix, which is a very important thing. It kind of shows lenders that you can be responsible with different types of credit as well. All right, good job on that one. So let's go on to the next one here. True or false? Most derogatory information stays on your credit report for 7 years. What do you guys think about that one? Yes. So this one is true. Most derogatory information is going to stay on your credit report for 7 years from the date of that original delinquency. So the types of derogatory information that are typically removed after the 7-year period is going to include any late payments that are showing, any charged off accounts or collection accounts, foreclosures, repossessions, or any settlement. So if you settle the debt for a lesser amount than you actually owed, that's going to also report on as a settlement, which can negatively impact your credit. So all those types of things will fall off after 7 years. Some of the exceptions to this are bankruptcy. So Chapter 7 specifically can stay on your report for up to 10 years. Unpaid tax liens used to actually stay on your report indefinitely, never fell off if they still went unpaid. But thankfully, most of the major credit bureaus are not actually reporting those anymore. So that's a good thing if you did have any unpaid tax liens. Another thing that might not fall under the 7-year rule is student loan defaults. So depending on, if it was a federal student loan or a private student loan and different things like that, there can be different timelines depending on the loan type. So that could be something that might stay on your credit report for longer than 7 years in some cases. All right, let's see the next one. True or false? I cannot fix my credit because it is too bad to repair. I'm sure all of us have felt this maybe a time or two in life. But what do you think? Yes, so this is definitely false. Let's give everyone some hope here that's here tonight. So you can fix your credit, no matter how bad it is. Credit repair is possible with time, consistency, and the right strategies. So that's why we're here to help. As we just touched on in the previous question, negative items are going to eventually age off your credit report, right? So that's a good thing. They are, if they are paid, they're not going to be there forever. 7 years might sound like a long time now, but as we all know, time flies by, right? So it's going to reduce that impact over time. There's also some ways that you can have some positive impact while you're rebuilding your credit. So paying bills on time. Obviously, this is a huge part of your credit factor. The biggest part that ties into your credit score are those on-time payments. So really, starting from today and being able to make those on-time payments is eventually going to help, even if you still have some derogatory marks on your credit. Reducing the overall credit card balances, right? So that's going to help that utilization ratio to be better by bringing those balances down and not carrying a maxed out credit limit month over month. Sometimes using a secured credit card option or different types of credit building loans that lenders might offer could be helpful. So with a secured credit card, you're actually putting the money down for that line of credit. So maybe the lender is saying, based on your credit report, I don't know if we can trust that you're going to pay us back. So we'll give you a $500 limit, but you have to put $500 in this account that will hold for you against this credit limit. Usually, there's a certain time range that goes with that. So maybe it's a year. So if you keep this in good standing and make your on-time payments for a year, then maybe they'll be able to release that, security that you've put on that credit limit and give you just a regular line of credit. So yes, that is definitely ways you can help to improve. So, credit scores, they're dynamic. They are going to update monthly and sometimes even more so than that. Now that the credit bureaus, things can change almost on a weekly basis or a daily basis, depending on what's reporting. So just know that and know that those positive changes are going to help you over time. And I've seen, as when I was a lender for many years, I've seen people that had a bankruptcy and within the year, they've been able to make enough, positive impact on their credit that they're bringing their credit score up by, hundreds of points sometimes. So just because you have some of those, things that feel very negative doesn't mean that, there's not a light at the end of the tunnel there. All right, last question, true or false? Employers can pull credit before they hire you. Maybe some of you have had experience with this, but what do you guys think? True or false on that? Do employers have the right to do that? Yes, so we're getting a lot of truths from the audience here. So yes, this is true. Employers can pull your credit report before hiring you, but only with your written consent. Employment credit checks are used to, evaluate overall responsibility. How responsible are you? Trustworthiness, financial behavior, especially if you're working in a job involving money or sensitive data and things like that. So this is one way that employers can kind of do a little bit of a background check to see, how responsible you are. So when they check this information, it is usually a soft inquiry, so it's not going to impact your credit score negatively. They also don't actually see your score. They just get the raw data of what loans you've opened, your payment history, what loans have been paid off, things like that. The practice is also regulated under the Fair Credit Reporting Act. So that makes the employers required to get your written consent, like I said before. Also, if they do take an adverse action and not hire you because of the information they found, they do actually have to report that to the agency as well. So there is a paper trail there if anything adverse did happen because of what's on your credit report. All right, cool. So we got through those true and false. Thanks for participating with me there. All right, so let's get into the basics here. So basic definition of credit. It's a contract agreement in which a borrower receives a sum of money or something of value and repays the lender at a later date, generally with interest assessed. All right. So a couple things that go into the report. You have the report, which is just that data, every loan that you've applied for, the loans that you've been approved for and have opened, your payment history. Any other, legal actions or collections or, repossessions, all of the data is in your report. And then you have the score, which is a separate thing. Usually you have to pay for that in addition to your credit report to actually see your score. Or if you have a credit line with a lender, usually nowadays they do offer to give you a credit score on a regular basis. So that's pretty nice. So those are the two types of things that kind of go into what you'll see on this credit report. A couple things that are not included on the report are your race, religion, gender, marital status, and income. So none of that information at all, none of that personal information is going to be included in the credit report. All right, so let's jump into the big factors that are going to, make up your credit score. So the first one, as you can see, the biggest factor at 35% is payment history. So definitely the most important factor is if you're paying these bills on time. It reflects whether you've paid past credit accounts on time, including any late payments, collections, charge-offs, bankruptcies, things like that all go into the payment history. Consistently paying on time is going to help build that strong score. Then depth and type of credit. So this has to do with not only the length of your credit history, but also that credit mix, like I talked about, having different types of loans and showing that you're able to handle different types of loans successfully. So the age on all your accounts. So, usually, you'll hear, if you, hear tips from different people about building up that credit score, even if your first card that you opened, for me, it was like a Target card back when I was, 18. So I've now had that credit report for, about 25 years or so, or that credit account. And even though I don't really use the card at all anymore, I'm never going to close it because that's my oldest card. So, I have all of this history built up. I don't want to let that go. So probably going to keep that card open no matter what, just so it wouldn't, impact my credit by closing that. So length of credit history, and then that credit mix. So, you might have credit cards, auto loans, mortgages, student loans, different things like that. So that's a good mix showing that you can handle different types of credit and different payments over time when the lenders are looking at your credit. And then credit utilization, we did talk about that, right? How much of your available balance are you using? Oh, sorry, let me go back here. So with credit utilization, it looks at, how much of that available credit you actually have. This is where you ideally want to keep the balance is at 30% or less of your available limit. So if you have $1,000 limit on a card, you'll want to make sure that you're keeping it at, $300 or under as that balance month over month. That's just kind of a number that we've come up with because we see that once people are carrying that higher utilization above 30% is usually when we see the credit score negatively impacted when they carry that higher balance month over month over month. So that's something good to keep in mind as far as credit utilization. And then recent credit. So it is good, lenders do like to see, and your credit score will be positively impacted by, opening a new loan every now and again sometimes. Although sometimes you do take that hit for the initial, hard inquiry on your credit. Definitely, having new credit is not always a bad thing as well. All right. So with here, this just shows, kind of like loan information here on the left. And then more importantly, definitely on the top right here, you'll see one late payment can lower your score by 100 points. So this is definitely something that we've seen happen. Somebody with perfect payment history, they miss one payment, and that credit score drops. This, it can also depend on the loan type. So, if you make a mortgage payment late, that's where you might see this 100-point drop instantly. So it kind of depends on the type of loan as well, to see, how much that late payment is going to impact your credit score. And then always make sure you're reviewing your credit card statement. So on that bottom right is kind of some information from a credit card statement. So they're a little bit different with each lender, but so this just gives an example. And it's just important to look over the details of what was charged this month. Were all those transactions mine? So really take the time to look at it. I know I've been in places in life before where I did not want to open those bills and look at them, and I felt better throwing them away. I learned over time that was not the best choice, and I really did need to look at these and really get a grasp of where I was at and what I was doing. So one thing that I didn't know until I, became a financial educator was this information on the bottom right, the Schumer box. So that little box that shows if you only make the minimum payment, it'll take you 23 years to pay off this $8,000 balance. But if you make $278 payment each month, which, as you see, is only, about $100 more than the minimum payment. If you're able to make that payment each month, it would only take you 3 years, and you'd save you'd save $4,000 in interest. So it's good to really review these. The credit card statements can be very helpful and eye-opening. So just make sure that you are reviewing all that information. Make sure, you have your payments set up. If you do set up automatic payments, which I highly recommend, then, you can make sure you have your payment due date correct and all of those things, and that you're making at least that minimum monthly payment, if not the full previous statement balance, to get that paid off that month. Okay, so then let's get into depth and type of credit. And we're going to talk about kind of a little example here, a little scenario with two different people. So you'll see person A and person B, they both have 3 credit cards open currently, all right? So they opened one credit card 7 years ago, one credit card 3 years ago, and then another credit card a year ago. So person A on the left, they decide to close this credit card that they just opened last year. All right. And person B on the right decides to close, maybe it's an account they're not using anymore. So they decide to close this card that they opened 7 years ago. So who do you think, person A or person B, who do you think's whose credit is going to be more impacted by making the choice that they did? If you guys want to put your answer in the chat there. Remember, we talked about payment history, right? So yes, definitely. So person A, who decides to close the card that they just opened a year ago, is going to be a little bit less impacted by the choice that they made, because person B is going to be losing 7 years of positive payment history. Even though they're not using that card anymore, like I said, like I'll never close my Target card because it's my oldest card. That would be kind of like in this case, right? So taking away, that good payment history, as well as taking away that available credit limit. So especially if it's a card that you're not using, but you have that full availability on the card, that's really helping your credit right now. So losing that credit limit, if you do carry balances on other cards, that's instantly going to up that utilization rate. And we know that can really impact score. So really, even when you're thinking about closing cards, which sometimes it's necessary, if you're in a place where you're going to run that card back up, then maybe it is the best choice to close a card, right? And take that temporary hit to your credit. But if you know that you can, you've been consistent, you've been responsible, you're not going to run that card up, maybe even just, you've cut up the card, it's not even available anymore, but keep that credit line open because that can be a positive impact on your credit. So situations are different for everyone. And obviously, us at the credit union are definitely here to help you. If you do have any questions, we're always here to kind of give some different tips and tricks to try to help you in the best way for your situation. All right, then we'll move into different types of credit. So with loans, you may have heard these terms. You have installment and revolving. So installment loans have a set end date, right? So like an auto loan, we're getting our $20,000 auto loan for 72 months. We know that after 72 payments, it's going to be paid off and the loan will be closed and reported as paid. So those are installment loans, usually those secured loans or things like that. But sometimes they could be unsecured, like a signature loan or a home improvement loan, something like that. But either way, installment loans have a set end date and a set monthly payment each month. And then revolving loans, it's kind of revolving because as you pay it off, that available limit or that limit becomes available to you again to use. So that is why that's called revolving. So those would be your credit lines, maybe store cards that you've opened, a home equity. Usually a lot of home equities are a line of credit. So usually, a home equity will be for 10 or 15 years that you have this available credit limit that you can draw from. But usually it does have to be paid back within a certain amount of time, but usually it's a little bit longer that you have that available revolving home equity loan. All right, and then with the installment loans, you have secured and unsecured. So with secured loans, there is something backing that loan, some sort of collateral, right? So we talked about the secured credit card as a way to build credit. So that means you're putting the money down to open this line of credit. Other collateral could be like a car, right? So you're getting an auto loan. That car is the collateral that the lender is holding there. So if you default on your loan, they can take the car back and try to get some of their money back, right? So because there's collateral backing these, they are a little bit lower risk to the lender, which in turn is going to lend you lower interest rates as the borrower. And then with unsecured, there's not going to be any collateral backing up the loan. So to the lender, this is a little bit higher risk because if you default on that loan, there's nothing they can take back to pay off this loan or get back any of that debt, right? So because of that and the higher risk, there's going to be higher interest rates along with these unsecured loans. So definitely something to take into consideration. If you can do a secured loan, you're going to get those lower rates. All right, and then we will move into credit utilization and availability. So again, we'll kind of go through an example here to kind of put this in, a little bit easier terms. So once again, we'll have two different people here. So person A has two credit cards open. So they have one credit card with a $10,000 limit and they have a zero balance on that card. So they have 100% availability on that first credit card. And then on their second credit card, it also has a $10,000 limit, but they're carrying a $5,000 balance. So on that card, they have 50% availability. So you add those up and their total utilization, they're using 25% and they have 75% available. So that's pretty good, right? That's under that 30% that I mentioned we like to see. Person number two, we go back to that credit card example, they decided to close that one card, right? So now they only have one credit card with a $10,000 limit that they're still carrying a $5,000 balance on. So because they chose to close that card that they weren't using, that had that available limit, they've now forced their utilization rate to be 50%. So even though both of these people are carrying the same dollar amount of balance, the utilization for person number two is much higher and is going to, possibly negatively impact their score, even though they're both carrying the same dollar amount of debt. So something to consider there, but just kind of gives you a better visual of how utilization works. And remember, once again, we like to really pin this down, but that 30% is that magic number. So try to keep that revolving debt under 30% at all times in order to not have any negative impact on your credit. And then also, we want you to always ask for disclosures when you're opening a new line of credit or a loan of any type. You should be getting disclosures from the lender that will really detail. It's all that fine print. But it is important to kind of look this over to know what you're in for. Obviously, none of us plan on paying late or, plan on taking a cash advance off of a credit line, but sometimes it happens. So you'll want to know what you're going to be dealing with if you do have to go down that road. So it'll show you the interest rates that they offer. It's also going to show you different interest rates for, like if you do take a cash advance or if you do a balance transfer from another card over to this line of credit. And then also, the late payment fees are down here. Or if you, use the card internationally, different things like that. So always look for the disclosures. Is very important to know what your, this contract that you're signing. And then with on the left, we'll see those inquiries. So generally, the hard inquiries to credit, like when you've actually applied for something, is going to stay on your credit report for 2 years. So, when I was a loan officer and I was pulling people's credit, sometimes I'd see, somebody that had, 5 or 6 credit pulls in 1 week. I would ask questions as the lender. And, sometimes it was that they were shopping around for car loans or they were shopping around for mortgages, right? So just explain to your lender if you do have, kind of several credit pulls within a short time. Thankfully, the credit bureaus have changed the way they're kind of grading these into your score. So, they can also see if you are applying at different car dealerships in a short period of time. That's going to affect your score a little bit less than, if you're just applying for different credit cards every single month of the year. And if it gets excessive, if you have like 20 or 30 or more inquiries, that's going to look a little excessive to lenders, and they might ask a few more questions in that application process. So just be aware of that. And hopefully, we've already explained this, but the difference between the soft pull and hard pull to your credit. So things like, a employer, that's going to be more of a soft pull. Anything that you actually fill out an application for is going to fall into that hard inquiry that's going to stay on your credit for up to 2 years. So applying for credit cards, applying for auto loans, applying for mortgages or a home equity loan, anything like that is going to be a hard inquiry. And then the soft inquiry will be from those employers. If you check your own credit, that's a soft inquiry. So that's not going to impact your credit at all. Applying for car insurance. So that's something that some people don't realize that credit is pulled for, but it is, and it can affect even the rates that you get for your car insurance. And then those pre-approval offers that we all get in the mail from different, lenders, those are based on a soft inquiry that the lender had access to. So let credit help you. So, we talked about, building that good credit score, but, and a lot of people are weary of credit cards, especially when you're new to credit. Maybe you've only heard, negative things from friends or family members about, some sort of, line of credit that they took out and weren't able to pay. And now, all of that. But there is positive things to opening your first credit card too. So it really is truly the only way to build credit without paying any fees. Because if you, choose to use the card responsibly, maybe we're just going to charge our tank of gas each week on it, right? So it's going to be a manageable balance that we can actually pay off each month. If you're able to pay off that statement balance by the due date, then no interest is assessed. So really, even though a credit card might seem scary at the beginning, or if you've had bad experiences in the past, it really truly is the only way to build credit without costing you any additional fees or interest. If you open, if an auto loan is your first loan, that's great. And that's going to help your credit mix. And that's going to show, that you're a responsible person and can pay back. But there's going to be an interest rate tied to that auto loan that you're going to be paying the lender for, right? So, so any other type of loan is going to have interest automatically worked into that payment. But with a credit card, if you are able to handle it responsibly, maybe add one bill to the card, wait for the due date, and pay it off in full, you're going to be building positive credit very quickly and not paying any additional fees or interest. So just kind of a different way to look at that. Building up your payment history, keeping those amounts owed down, and you're going to see that positive history build up really quick. All right, so let's move into the impact of what your score is going to do for you. So once again, we're looking at two scenarios here. So both of these people are getting the same exact type of auto loan. So they're getting a $25,000 auto loan over a 60-month term, right? So 5-year auto loan, $25,000. Person A has a credit score of $720. Because of that good score, that's what we consider a pretty, good, actual good score, 720 and up. They are going to be eligible for a rate of 7.54 for that 60-month term. Person B hasn't handled their credit as well, right? So they're at a 638, which isn't horrible. But because they've shown, that maybe they're not as responsible with how they've handled their credit, the lender is only willing to give them a interest rate of 15.14. So you can see, even though that credit score is less than 100 points than person A, that interest rate is over double that of what the person A is going to be paying. So difference in monthly payments, person 1 is going to have a monthly payment of $501, while person 2 is $597. So almost $100 difference in there. So over time, person A is only going to be paying $5,085 in interest over that 5-year period. Person B is going to be paying $10,795 in interest. So person A is saving over $5,700 in interest by having that better credit score. So really, the impact of your credit score is very important. It's, can cost you a lot of money over time, when you do need to go get those loans. So very interesting when looking at it like that. All right, and then we've kind of already talked about these, but we'll just touch back on them real quick. So items bringing down your score could be, credit cards. So maxed out cards. So if you're carrying a maxed out credit limit month over month over month over month, you're definitely going to see a negative impact on your score. Also carrying more revolving debt than installment debt or secured loan debt. So try, to build up your credit in a way that you do have that good credit mix. Late payments, like we already talked about, very important. And how the impact, depending on the loan type, if it is a mortgage payment, that might impact your score more heavily than if it's just a small line of credit that maybe you had one late payment on. Those derogatory items, which are going to stay on for 7 to 10 years, like we talked about, and counting against your positive payment history. Clearing, trying to get those cleared up, as well as, disputing any inaccurate information. So sometimes this is just due to human error. Something got entered incorrectly, and it could be impacting your credit score. Maybe a social security number got transposed somewhere, or something was open, all types of things happen. So really important to look at your credit report and dispute any of those, and make sure there's definitely no ID theft. Obviously, that's very common in this day and age. So those are some definitely good reasons to check your credit report regularly with all 3 bureaus. So doing the math, when you're really ready to, if you are carrying a lot of credit card debt and really want to start attacking that debt and you're motivated, really do the math on this. So maybe first consider what items have the highest interest rates. So, if you are ready to start paying down debt, maybe you want to, first pay down those balances that are carrying those really high interest rates. That's going to save you a lot of money over time, right? So really getting out those bank statements, making a list, making a spreadsheet, using an app. There's a lot of those out there these days that can help you manage credit card repayment yourself. So definitely look into some of those and really, analyze how much you're paying in interest and what would be smartest to pay off first. what items are the most severe. So, do I already have a lot of things in collection? Do I have maybe a couple credit cards that are a few months late, but maybe I could get them back to a current paid status? Maybe I want to focus on those first, right? So these are things that you'll definitely want to look into when you are ready to kind of get back into that repayment and you're handling that on your own. Definitely a lot of, like I said, there's a lot of different help out there and resources, and we at the credit union are definitely always here to answer any questions as far as that goes as well. What options do you have? So, have you called your creditors and talked to them about what your different options are? Maybe they have different programs that they offer themselves, to help get you back on track or help, bring down interest rates so a lot of times lenders, they want to hear from you. When you ghost them, they're a little bit less willing to work with you on things after time goes by. So really keeping those lines of communication open is really important. And then we now know how long those items might stay on your credit report or how long those hard inquiries might stay on your credit report. And, once those fall off, you may be seeing how that impacts your score, if that changes it, if it goes up or down. So those are kind of important things as well. And then resolving debt on your own. So, if there is something inaccurate, definitely dispute it with all 3 credit bureaus if it's something that's reporting to all 3. One thing with disputes, always make sure you're keeping track of all the communication that you've had with this lender. If you do have to send any letters, via the mail, maybe send it certified so you have some way to track that. Write down names of who you talk to if you're speaking with people over the phone, different things like that can be really helpful. If the debt is valid but unaffordable at this time, it might be good to get on some sort of payment plan. So like I said, keep those lines of communication open with your creditor, or if you're just digging into maybe some collections that are on your credit report, reach out to that collection agency. Usually their phone number is listed right on your credit report as well, and explain your financial situation to them. Maybe you propose a monthly amount that you're going to be able to afford. A lot of times those debt collectors, they want to tell you how much you're going to pay, and that's that. But, if you're, respectful in the negotiating process, you might be able to get somewhere with some of these agencies. Sometimes they might be willing to like freeze the interest, not add any more interest, or waive, late fees that were put on previously. So maybe, I had a $500 balance I owed, but now after I didn't pay this bill for so long and there's all these late fees, there's another $500 just of fees. Are you willing to forgive that if I can pay the actual balance that I owed? So just, try to work with them on that. See, if there's anything they can do to help you through your situation. Once you do make an agreement for a repayment, always make sure you get that in writing, at least an email or something like that. So that, once you start making payments, if anything, if they say, oh, well, you were supposed to pay this much each month, and you're like, no, this is how much we agreed to. So just make sure you have documentation of all that. Another tip is to probably not give direct access to your bank account to some of these lenders. So, a lot of them will want you to set up like an electronic payment, an ACH payment, by giving them your routing and account number. But sometimes that can get you, in an even worse financial place, because what if they try to pull the payment and you don't have the money in your account, or what if they pull it a day early before your payday, and then your money's not there, and then your bank charges you a $30 fee for the insufficient funds or something like that. So if you're able to pay the lender directly or send a money order, check, or something like that, that might be a better option than just setting up that automatic withdrawal from your account. And then lastly, settling debt. So if you do have a lump sum of money available, it may be possible to settle the debt for a lesser amount than you owed. So some of these lenders that are willing to do the debt settlement, they may take, around like 40 to 60% of what you actually owed. Just kind of depends, but that's kind of just the average. So once again, negotiate with them, let them know this is what you have available. Are you willing to settle for this amount? Don't agree to more than you can afford, more than it's in your budget. Again, get that agreement in writing before paying that off. And then also you can check with them to see how they report it to your credit after it's paid. So are they going to report it as paid in full? Are they going to report it as settlement? So sometimes depending on that, your credit can be negatively impacted if they do report it as settlement, because then lenders know that, you did not pay the full amount that you owed, you paid a lesser amount and the lender just was willing to take that. But ultimately, that hit that your credit may take negatively in the short term is still probably less impactful than not paying that bill at all, right? So leaving it unpaid is definitely probably a worse option than settling. But like I said, everyone's situation is different, so try to get some guidance on that as well before you make any decisions on what would be best for your situation. We also wanted to share Green Path is a partner of MSUFCU, longtime partner. You may have seen them. Sometimes they host different seminars for us as well. But they do offer free one-on-one debt counseling where they'll review your current financial situation, what your goals are, and they'll provide a personalized action plan to help eliminate that debt. They can also help with debt management programs. So there is a difference between debt management and debt settlement programs, like the ads that you might see late at night on TV for those debt settlement companies. Usually their tactics and strategies hurt your credit a little bit more than just a debt management program. So with Green Path, they will help you to consolidate multiple payments into like one monthly payment and kind of manage that for you. They also do negotiate with the creditors, but their strategies are a little different as far as, some of the debt settlement companies just take your money and then they just don't pay your bills each month. They wait till they get in default and then they call the credit card company and try to settle. Green Path handles it a little bit differently so that your credit, hopefully will be positively impacted throughout this process instead of negatively at first. Even with the Green Path debt management program, there are some, small monthly fees and things like that, but they'd be willing to talk to you as well if you're to the point where you think this might be helpful, and they'll let you know any options they can offer to help you through this. They also offer, beyond just like the debt management and that type of thing, they offer student loan counseling. So if you're, getting to the end of, your schooling and you know that you're going to be in student loan repayment in the next 6 to 12 months, they can kind of walk you through that and understand different repayment options and programs, or even potential, loan forgiveness programs that you might be eligible for, depending on what industry or career you're working in. They also offer housing counseling. So this could be support for, foreclosure prevention. If you think that might be, something that may happen in the near future, rental counseling, as well as first-time home buyer education. So they have a lot of different webinars, recorded, seminars, different interactive things on their website that they can help you with. And a lot of other financial education, just like MSUFCU offers. So yeah, you can go ahead and check them out, greenpath.com, or you can call that 800 number if you do want to speak with them about your situation as well. Finally, wanted to also share, which hopefully you know about this website by now. It's been around for a while, but if you don't, annualcreditreport.com is where you can access your credit report from each bureau, TransUnion, Equifax, and Experian, at least once a year and get the full report. So definitely use this. Doesn't cost anything. You won't get your credit score, but like I said, usually if you have a credit card with any other lender, you can usually get your score. If you're already a member with MSUFCU, we offer your credit score once every quarter as well. But this is more so you can get the full report, look at the information that's reporting, make sure it's all legit, and kind of go from there. See if there's any collections or, sometimes those things happen without even knowing, like medical collections and things like that. So it's good to take a look at your credit report each year and make sure that everything is accurate on there. So finally, some final tips: make those payments on time and keep those accounts in good standing. Don't be discouraged by setbacks. This happens to all of us, right? So just, it's a new month, get things on track. Maybe you weren't able to stick to your budget last month. Maybe you could only make that minimum payment on your credit card. But every day's a new day. So don't be discouraged by those setbacks. Start anew, get a new plan in order and stick with that. Document all steps taken to dispute accounts or set up payment plans. Like I said, if you have set up a payment plan, get that in writing or email so you do have proof that you spoke to someone and this is what you agreed on. This is what you're going to pay each month. And continuing to monitor your credit report and information regularly to make sure everything is accurate. All right. So we also wanted to share a new resource that MSUFCU offers to set any young people in your life up for success. It's our Funtivity Zone. So you can scan that QR code to get there. Offers a lot of different videos, interactive resources, and kid-friendly lessons to kind of, start that financial literacy early, so some of these are even good for kindergartners or and beyond. So definitely check that out. This QR code will bring you to just our financial education page with different resources and things like that. We also have our Wallet Watch podcast each month with some really cool information. We are focusing on fraud coming up. So that's definitely something that, impacts all of us. I'm sure we've all gotten those text messages about paying our tolls, recently. I think that's the one that everyone's getting. So yeah, those scammers are out there. Fraud is really running rampant. So check out our Wallet Watch podcast. That can give you a lot of good information and all those other resources that we offer here. All right. So that is all I have for you this evening. Let me check the Q&A and see if we had any questions. Okay, so we did have one question come in here. Is Credit Karma legit? So yes, I believe Credit Karma is only tied to one of the credit bureaus, but yes, I use it. It does ask you a lot of security questions as you're setting up your account. So from what I know and have used in my personal experience, I haven't run into any issues with Credit Karma. And it, like those other credit apps, it kind of updates your credit score pretty regularly. Like if I if I apply for something new and have a credit pull, Credit Karma sends me a notification like the same day and tells me your credit was pulled. So a lot of those things are good just to to monitor in real time your credit. So definitely, yeah, I would definitely say that, using one of those can be very helpful to monitor credit. All right, Jill, well, I don't see any other questions coming through. So thank you for being here with us tonight. And I hope you can join us again at another seminar series coming up. So we will see you soon. Everyone have a good night. Thanks.